Today we're diving into one of the biggest names in tech and retail, Amazon stock. With shares recently taking a hit after their Q4 2025 earnings, a lot of investors are wondering if it's time to buy the dip or run for the hills. In this quick video, I'll break down the 5 most important things you need to know about Amazon stock right now. We'll cover recent drama, the business basics, valuation secrets, future prospects, and why the market might be dead wrong. Let's jump in. Number 1, what's happening right now? Recent news and market reactions. Amazon just dropped their Q4 2025 earnings bomb, and the results were mixed. Revenue smashed expectations at $213.4 billion, up 14% year over year, driven by strong holiday sales and AWS growth. But EPS came in at 1.95, a tiny miss compared to whispers on the street. The real shocker? Their 2026 capex forecast of around $200 billion. That's massive spending on AI, data centers, and infrastructure. The market freaked out, sending shares tumbling 8 to 10% in after hours, closing around $223 as of February 5th, 2026. That's down from a 5-2-week high of $258, wiping out about $230 billion in market value overnight. Investors are worried about short-term profitability dips from all that spending. But remember, this is Amazon. They've turned big bets into empires before. Overreactions like this have created buying opportunities in the past. Number 2, the business model and industry structure, with its limits and consequences. Amazon isn't just an online store anymore. It's a diversified beast. The core model, e-commerce retail, about 60% of revenue, where they sell everything from gadgets to groceries via a massive logistics network. Then there's AWS, the cloud kingpin, 18% of revenue but 60% of profits, powering everything from Netflix to your bank's app. Ads and subscriptions like Prime round it out, creating a flywheel. More users mean more data, better recommendations, stickier customers, and higher margins. The industry? E-commerce is hyper-competitive with players like Walmart and Shopify, but physical limits hit hard. Think warehouse space, truck fleets, and data center energy hogs. Consequences? Scalability is huge, but supply chain snarls or regulatory scrutiny like antitrust probes can bite Amazon's edge. Their customer obsession mantra turns these into advantages, but overexpansion could strain cash flows if growth slows. Number 3, foundations of valuation and key indicators. Amazon's worth a whopping $2.38 trillion market cap today. But what's it based on? It's a growth story, not a value play. Trading PE is 31.45. Forward drops to about 27 pricey, but justified by 11 to 12% annual revenue growth projections through 2027. Key indicators to watch. AWS revenue up 19% last quarter, signaling AI boom. Operating margins hit 10% in Q4, thanks to efficiency. And free cash flow turned negative short term from capex, but historically a cash machine. Price to sales is 3.48, EV per EBITDA 15.41. These scream premium because of Amazon's moat. Physical industry limits like chip shortages or energy costs cap upside. But if they execute, these metrics could expand further. Bottom line, valuation hinges on turning capex into explosive AI-driven profits. Number 4, prospects, transitions, and competitive advantages. Amazon's core retail is transitioning to AI-optimized logistics, with robotics cutting costs. Expect margin pops here. AWS is the star, with AI catalysts like custom chips and Bedrock tools fueling 20% plus growth. Ads could hit $60 billion this year, low-hanging fruit. Overall prospects? Bullish, with revenue eyeing $796 billion in 2026. Key catalysts: AI adoption accelerating, grocery push, think Whole Foods expansion, and potential ad surges from Prime Video. Will advantages persist? Absolutely. Foundation 1. Network effects from 200 million Prime members lock in loyalty. 2. Scale in logistics crushes competitors' costs. 3. Data moat from billions of interactions fuels unbeatable personalization. These aren't going away, they're widening. But watch for transitions like heavier AI reliance. If it pays off, it's rocket fuel. If not, short term pain. Number 5, market consensus. Why it's wrong and true stock value. The street loves Amazon. Long term analysts rate it a strong buy with targets around $300 to $311, implying 35% upside from $223. Consensus sees steady growth, but frets over capex eroding near term FCF. Why wrong? It's an overreaction. This spending is future proofing against AI rivals like Microsoft. In a bull scenario, AI booms, margins hit 12%. New info like blowout AWS quarters could push sentiment to euphoric, re-rating PE to 35 and stock to $350 plus. Bear case, regulatory hits, capex flops, dips to $180, but unlikely given foundations. If moats hold, and they should, fair value is 300 plus in 12 to 18 months, 35% above now. Consensus underestimates the AI transition. As winds roll in, it'll flip bullish fast. There you have it. See you in the next one.